Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 28th, 2019. In lieu of doing a market wrap video, since there weren't any notable developments in the markets were virtually flat. We had a slight green close in the S&P 500 and NASDAQ 100. As such, there weren't any significant developments to report. So more of the same there. On top of that, I already did included an overview of the broad markets in the earlier video today for members. So what I'm going to do in this video is from time to time I like to drill down and do analysis on the 11 sectors within the S&P 500 for two reasons. Number one, the stock market is simply a sum of its parts, and so if you look at the 11 sectors of the S&P 500 and can gauge where those sectors are going, particularly the heavy-weighted, top-weighted sectors, then you have a good idea where the market's going. And then also on top of that, there are potential trade ideas in those sectors. There are times where certain sectors are going up when others are going down, and vice versa. And I also like to do a top-down approach with my analysis and finding trade ideas and setups. Look at where's the broad market going, where's the primary trend, or more importantly, where's the next trend likely. I know there's a lot of what I call trend followers out there, but I like to anticipate trend turns, get in front of those trends. So it's more so, again, where is the market likely headed in the next 2, 3, 4 months versus what's it done for the last 2 or 3, 4 months. Now on that, so if you can determine where the market's going, then drill down, find the most bullish or bearish sectors within the market, and then within there also often go down and drill down further and find the most bullish or bearish individual stocks within each of those sectors. So we're not going to go that deep down right now. We're just going to do a brief overview. I'll start out with the big picture of the S&P 500. This is a weekly chart. Goes back, covers the last bear market, and what stands out to me, a lot of things I've covered before, is is this was a top in '07. This was a initial leg down. This was our first bear market rally. The similarities I've talked about before. There's my old trusted and tried and true, super simple and effective, which makes this trend indicator so good is how simple it is. Just looking at the 9 EMA, the signal line on the PPO, that's the white line, and when it crosses below 0, it tells you that the primary trend is flipped to bearish, and when it goes back above, it's bullish. So with a 0% failure rate, we've only had 1, 2, now 3 periods for well over a decade. This goes back, you can see coming into the bull market highs, it was still well above that level. We can roll back even farther if we want to see that. All the way back to the last bear market. So with near impunity, it has marked the bull and bear markets in the past, bullish and bearish trends with looks like 0 failure rates here as I go through each of those. Even though this wasn't technically a bear market, some considered it. It was a drop of over 20% in many sectors and indexes, and as was this one back here too in early 2011. Even the SPY itself dropped. Oh yeah, it looks like 21%. So there it is. Okay, so now the point I'm trying to make here is we had the initial, we crossed right there, and then what we had is a kickback rally. Oh yeah, I wanted to point this out too. Oversold. So a lot of similarities on that first leg down in the bear market back in 2007. We had a comparable drop, and at that time what it did, remember, nothing goes down forever. Oversold, especially the initial leg down in a bear market, because that's when everybody's still in bull market mode. Nobody believes it's a bear market until the wave 3 hits. So at that point you are oversold, and oversold is a golden buying opportunity, especially in bull markets in particular. And so back then, just like in December, we hit that, and that was there were a lot of green lights to buy. So again, this has been talked about for a long time by me and I'm sure others. So whether this proves to be a bear market rally or not, only time will tell. But we're still below that key resistance level. I'll get to that in a second. And that trend indicator is still coming up now and testing that 0 line from below. As I say, it does a great job of not only defining bullish and bearish trends, but the 0 line, which does so when it's above or below, often acts as support or resistance when tested from above or below. So in this case, back in 2015, you had a sharp correction, kickback rally, almost took us all the way back to the previous highs, and then boom, another big leg down where we undercut those lows, and that was a rejection right at that 0 line. So like I've been saying for weeks now, and I know people are probably getting tired of it, but the market's not going up and it's not going down. That's the bigger picture. And so we're at a level where there's still a lot of things pointing to the fact this could be a bear market rally, but it would really, really, really help support that case if we reverse here. If we don't, you're going to start to see this trend indicator and some others flip over. You know, this is an important resistance level. So that's it. Let's not spend too much more time on that. 1, 2, 3, 4. Now we're in the middle of the 5th week. We just closed the middle of the 5th week of trading, failing to take that level out. So we'll get to the sectors now and take a look at those. Okay, and before I do that, I want to just you know, what I have a visual in my head, and it's this clip. I'm sure most of you, probably a lot of you, saw the Austin Powers movie. I think this was in the first one. I don't remember, but you know, it's a little clip where obviously it was a goofy movie. He's driving a steamroller at half a mile an hour, telling the people to get out of the way, as if they're going to get run over. This is what it feels like right now in the stock market to me. This is what this whole rally, and especially in the last 6 weeks, you know, looking for a big move, something to happen, maybe the bulls to get steamrolled here, and eventually it may happen, it may not, but that's kind of the visual I have right now of it. Just seems like it's taking forever, and now that is because, you know, the focus is right now, at least for me, on the weekly charts, and you know, it takes a long time for these charts to play out. We kissed that level back 6 weeks ago. It could if it is going to reverse, it could have reversed there, or we could test for another several weeks. Anything's possible. So we'll just have to watch that. Before I get off of this chart, let's just go over where I think things will head. If we do roll over here and get anywhere close to those lows, I think we'll undercut them. And this is still my preferred swing target longer term, and that's still from where we're at today in the S&P 500, talking about another 24 or plus % downside from where we're trading today. And here's the thing, it's either going to happen this year or it's not. If it does happen, the one thing I want to, or I feel strong on, it will happen a lot quicker than most expect. When you have these type of corrections, you do not zigzag down. You usually have these quick, sharp, very powerful sell-offs. So I guess the takeaway from that is, you know, don't fall asleep at the wheel. Don't give up. I see there's a lot of frustration in the trading room, and again, not putting individual stocks and individual trades aside. Anybody trading the broad markets, you know, for weeks now has gone nowhere. That's just a fact. All right, sectors now. Let's go back to my list. I have that watch list of the top components of the S&P. We'll go through these in order of market cap. I'll keep it quick. We'll just brush on the charts. Let's go through the weekly charts first. You can see the 11 sectors that make up the S&P 500. And XLK is just as it is with the NASDAQ 100. It's the largest sector in the S&P 500. So if I can grab this little box here, move it off the screen, get it out of the way, we'll pull up XLK chart. We'll go here where I have some annotations. And here's the bigger picture on the XLK. Again, tech is everything. When tech breaks, that's what I was saying back here. We're watching this trend line. When tech breaks, the market breaks. No two ways about it. It is 60% or so of the NASDAQ 100, and it's still of the S&P 500. It makes up a whopping almost 20% or 1/5. So you want to watch these stocks. You want to watch this sector. What do we have? You know, divergent highs, corrections, divergent highs. You can see them all marked in the past. And divergent high here. There's that trend indicator. Again, virtually zero failure rate for all the big drops. This was well over 20% drop in XLK back there off the highs. And again, if nothing else, even though it wasn't a vicious bear market, it was a multi-year sideways range, almost 2 years long, and that trend indicator told you it had a couple whipsaws, but that's the only other time it flashed red. Then right here, and you go back again, just measure out these moves. If you can grab the top there, that's about missed the top, so it's not the whole move, but about a 16% drop, maybe even more than that. All right, so that's it. Sharp, there's a V bottom so far. V bottoms are possible, although that's not common. Usually you get something like this. You have a sharp move down, you get a leg up, and you come back in. You'll see on a lot of ETFs like this, the sector itself didn't drop that much. It was a mini crash in many of those. So XLK, QQQ even, and some other ones. So it was essentially about a double bottom there. We tested in the lows back then. So that's one potential scenario. We don't have to go down to hit those 2015 lows that I had mentioned earlier as my longer term target. Maybe we come in and hit another hit this trend line once again. There's your uptrend line. But like I said, we're at a point where to keep this bearish case alive and well, the markets really need to reverse now. Otherwise, it just starts to muddle up the charts. You start to have this, and I'm sure some other trend indicators flip bullish, and of course, then you have the new highs not too far away, and everything else. So that's XLK. Let's just look at it on a daily time frame here. Divergent high on the PPO and an extreme overbought reading. You can see I put a line here. Let's color that a little bit different. So sometimes when I'm analyzing a chart, I'm not a mechanical trader. I look at everything different. In other words, some stocks, I usually have a 200-day, 50-day, 20-day exponential moving average up on my chart. You can see them here. But at times on certain stocks or securities, I'll look, and if it's traded through the 200-day like it wasn't even there and doesn't do a good job of support or resistance, I'll play around with the settings. I'll kick it up to a 220-day or 100, pull it down to 180-day, 170, till I find a good fit, because every sector, every stock behaves differently. So for example, example down here on the RSI, if you read a textbook about technical analysis, they'll tell you 70, the red line, is oversold on the RSI, and 30's 70's overbought, 30's oversold. That's default. So I didn't even put these lines here. They come in when you populate an RSI. However, that doesn't work for tech stocks. You start shorting or getting out of your tech stocks when you hit oversold, you're leaving a lot of money on the table if you closed your longs, and you're going to get smoked if you're shorting, especially in a bull market. So you can see what you want to do is there's two ways to use the RSI effectively, or at least to incorporate it into trading. Look for those divergent highs. You usually get a big pop. The next high on the RSI is lower. That is what we call negative divergence. And these divergences work. They work for big, powerful swing trades. They work much more often than not. They're not 100% effective, but you can see on this chart, we're going back at least 2 years. Without fail, we have 1, 2, this one wasn't marked, but that's a divergent high, 1, 2, 3, 4, now 5 divergent highs. You can see what happened if you got short around those last 4. You would have done very well, or got out of your longs. Maybe you don't short stocks, that's fine. And of course, divergence in itself, I always say, is not a sell signal or a buy signal. It's merely an indication of an impending trend change. So with XLK, what we have here is you had a fairly well and dangerously steep uptrend line, which was broken here, high level back test. I know that's a far stretch for back test, but that's what you get when you have a steep trend line. This is a normal sloping trend line. This was a normal sloping trend line right here. This is a dangerously steep trend line. So what happens is you either move down very sharply after the correction, or you come up with a sharp back test. So far that's what happened. And you can see here we had, again, this is really what I'm watching on SPY and QQQ. Those two big candles from last week, Thursday's and Friday's candles, and we're pretty much at the bottom of that range now. So for the bearish case, which I'm still leaning towards, I want to see us get away from there with conviction. A big, solid close down below that level. We've had some intraday spikes, but we haven't failed it yet. Of course, the bulls want to see us regain the top of last Thursday's candle. So that's it. If we want to oversimplify things here, there's your, I want to say, confirmed sell signal. It won't be confirmed until you really see it starting, the price is starting to move impulsively lower there. And again, if you haven't learned this lately, not just intraday, and sometimes not even intra-week, you need to see it on a weekly closing basis. But I'll follow up on that. If we see anything happen during the week, I'll make mention of it. And then back to that RSI again. Sometimes you get the one and done extreme. That's even a divergent high, a little lower one there. But sometimes you get the one and dones, and sometimes you get the divergence. But at the very least, you usually get at least a decent pullback there, and sometimes it's much larger. And so that's what we're coming off now. And then the other part to using the RSI in your trading is, and this is very important, there is a very, very, very big difference of trying to incorporate or extract any useful information off overbought and oversold readings, whether you're in a bull or a bear market or a primary bullish or bearish trend. What I mean by that, in bull markets, oversold in itself is usually good enough to just buy, whether you don't have buy signals. You can sit tight, even if you get an undercut, a second test of those lows, you rarely go far underwater. You can look at almost any chart, things that are correlated with the broad market like tech, go back in time and simply just buy when that RSI hits 30 and hold your breath. But what happens, like I said, is oversold or overbought tends to become much more overbought or stay overbought for an extended period of time. So let me rephrase that. In a bull market, oversold is not a good sell or overbought is not a good sell signal. It often becomes more overbought or stays overbought, whereas oversold is usually a very good buy signal, especially when accompanied with other technicals that confirm it. The exact opposite happens in a bear market. Oversold readings are usually very fleeting. They're one and done, just like, or overbought readings are usually very fleeting. They're one and done, just like oversold. And what happens is oversold tends to become more oversold and stay oversold for an extended period of time. So this right there tells us this is what I call a double tap. Those are in close proximity. There was a lot of separation between the previous oversold readings. We had two here that were fairly close, but nothing as deep. This one was really deep right there. So this is more typical of bear market action. And again, only time will tell if this was a bear market rally. If it was not, then I can tell you this won't be a big deal. We'll probably run up and make another overbought reading soon in the next couple weeks or few months here. However, if this is a bear market rally, and again, that's why we're at such an important inflection point. That's why I keep doing these videos, because I can, kind of communicate these thoughts. That will likely be it, and we'll come on down, and you may not see overbought for quite a while from this point. So that's something to watch. And again, hopefully we'll have resolution one way or another from this pattern, either to the upside or the downside soon. Or I should say this recent consolidation rate. Okay, let me shift gears on this video. Instead of running through, I was going to attempt to go through the weekly, daily, and 60-minute charts, because the weeklies are the big picture. You're not going to really hone in on your entries and exits here on the weeklies, but it helps to paint the bigger picture as to where we are and where we might be headed. Whereas the daily and especially the 60-minute charts help to zero in on an entry, whether you're going to go long, short, get out of a long position using a stop. But what I'll do is I'll run through the weeklies to paint the big picture on all the sectors, and then time permitting I'll go through the dailies and maybe even hit on the 60s on any of the sectors that really make a big difference to the S&P 500. So next up, and I'm going through these again on the watch list in order of market cap. This is the healthcare sector, second largest sector in the S&P 500, and again, it's that whole steamroller analogy I just showed you in the beginning. If I saw this chart on any given time frame, 15-minute chart, 60-minute chart, I would say the same thing. This is a beautiful, clean bearish rising wedge pattern. They work just as well on weekly charts as they do on 60-minute or daily charts. You have a very well defined uptrend line here. These are weekly candles. Those are just intra-week breaks, but all the bodies closed on it. And there's your divergence line right there. We had a divergent high back here with a 27% correction on that was a bear market for the financial or healthcare, and we just continued to wedge up since then. Extended the divergence, and so what we've had then was a breakdown, and we didn't just limp through there. It was an impulsive breakdown, and now a back test. So anything is possible. This trend indicator is still bullish right now. That's one thing giving me pause. Otherwise, we'd probably be short the financials right now. You can see it also doesn't do as good a job. These are all corrections, but a little more whippy here on the healthcare sector than XLK that I showed you a minute ago. PPO seems to be flattening down and turning down, so that's something to watch. But again, this brings me back to that point. We're at a very critical juncture. If these charts are going to play out the way they look like they are, or they should, based on what I'm seeing here, well, there's their back test. We back tested for a couple weeks, got a red impulsive candle, tried it again. But we haven't yet started to move impulsively away from there, where we can look at this chart and say breakdown, successful back test, and an impulsive rejection. So to be continued with, as with so many other things right now. I think the next few weeks will really give us some big clues as to what's in store for the market in the next quarter. So, all right, XLF financials. Not crazy about this trend line, but it fits better. We don't have a good one coming off the lows. Remember, the financials really, they almost collapsed. The banks were going heading to zero. XLF was down under $5 a share because of the financial system collapse and the government coming in and bailing out the banking system. So you really can't, that's a meltdown. So this is the best fit trend line I have here. You can see it comes off early 2011. And be a bull or a bear, I don't care who you are, you cannot argue the financials are in a bear market. They're down, as I've covered before, well off. They peaked in early 2018 and are well off the highs right now. I think they're still down about, 20% or so from where they were, almost, after dropping. Now, they hit trendline support. At least at that point, we had a third reaction, so it's valid. This is the line you want to watch. This is the, I'll call it the lights out line, especially that low. Again, if we come on down to test those December lows, I think we'll undercut it. Why? Well, on XLF, if you do test those lows, you're going to break the trend line right there. You have to break the trend line to get down there. Now, maybe you spike intra-week, close back above it at the end of the week. That could be bullish. It also has the potential to put in some bullish divergence. So these are things we'll watch. I'm not married to the view that we have to come down and test the 2015 lows, 2016 lows. It's the way I'm leaning right now. But like I always say, the markets are dynamic, and therefore so is my analysis. Changes every day. So we'll see how this one looks. But you can see right here, again, we're going back to I can go back as far as I want here, and with zero exceptions, this has just done a perfect job of defining bull and bear markets in the financial stocks, bullish and bearish trends. This was the bear market leading down to 03. Told you all along, without any crosses down below the zero line, that the trend was bullish until, this needs to be stretched here, until shortly after the market peaked in 2007. Told you to stay out of the market or stay out of the financials for most of the bear market. And then there were a few periods there where we did have corrections, so drops of over 20% in the financials, and it caught them all. And that's where we're at right now. So that trend indicator is bearish. The weekly PPO is clearly turned down, while the white line, which is the one that matters, is still below that zero line. You can see back in this drop here, looked like the financials were good to go after that first drop. Everybody figured it was safe to get back in the water because we almost reached the previous high, and then boom, another sharp leg down. And what told you that it wasn't safe to get back in the water was that zero line had not yet crossed. It was coming back to back test the zero line, got rejected, and then similar to now, although we're actually even farther below, we're not even to the zero line yet on that 9 EMA. So that's the financials, not looking great, but again, we're an important part. Oh, this one doesn't really, we can't do anything with XLC on the weekly chart because this is a new sector. The S&P 500 rolled out, they got rid of the old telecom sector and started a new sector called communications, so we don't have enough charting history on a weekly. We have to look at a daily chart because this one just started trading back last year, middle about June. So we have a downtrend line. We broke above it recently, and we've been moving up in this price channel right here. There is divergence forming. 47.77 is resistance. And again, I don't have a long-term chart, so we won't put a very heavy weighting into this, but these are levels to watch in the near term. Bullish if 47.80ish gets taken out. Bearish if this uptrend line gets taken out to the downside. This is XLY, consumer discretionary sector. The trend line there, find the best fit if you come in and exclude the meltdown into the '09 lows. Come in, you have a reaction here. And more importantly, a lot of individual sectors as well as the major indexes all have trend lines that come off here in the early 2016 lows. And so it's very well defined from there. So you can look at it that way if you want. There's your divergent high. There's your breakdown, back test, 22% drop, and simply another back test right now. So same story. And I know it's like that, whole steamroller. It's taken forever for this scenario to play out. But the takeaway too from this, guys, is right now I'm looking, with these swing trades, I have these typical swing trade targets that are measured, in the high single digits to low double digits. But on almost all those trades, there's the potential, and I may revise those targets and let those trades run if this scenario starts playing out. So what I'm trying to say is right now, for the first time in a long time, there's a possibility to position for a trend trade, not just a swing trade lasting a few weeks to a couple months, but a trend trade that could last 4, 5, 6 months or more. Normally in a long side trend trade, I would say years. The only thing about short side trend trades is stock market falls a lot faster than it rises. So you wipe out gains that took months or years are wiped out in just weeks or months during a bear market. So if we're going to hit this level, I think it's going to happen soon. If we're going to hit it in 2018, and like I said, I think it'll be a lot faster than what most people can even imagine right now if we start to get some downside momentum, if we fail here. Those are big ifs, guys. And if we don't, then the charts are going to be, the bearish case will be severely hampered. Doesn't completely eliminate it, but once you see these signal lines crossing here, like the 90 MA, other trend indicators rolling over, resistance levels are probably as or more important. Once you get those taken out, the previous highs, it just chips away the the whole, it doesn't fit well or mesh well. Right now, this still very much looks like the most likely scenario to me at this point in time. A couple more industrials. Industrials look better than most right now, the sectors in the S&P 500. This is a daily chart, or weekly. We're still in the weekly, so I'm going to get to the dailies in a second if there's time. The daily looks a little better. Even the 60-minute, there's some divergence there. Trend line I'm not a big fan of because I had to take some liberties, but we do have from this point 1, 2, 3, 4, 5 reactions, but we sliced through it there. We came up here. Trend indicator still bearish, so if you want to go by that metric, which I think you should at least respect it. Bear market again, I'm sure that was a drop of at least 20% or close to it, if not. Bear sideways market for a couple of years there, and most of that said stay out. And again, we're crossed down bearish, and we're still, that zero line is still right there, coming up on the signal line, coming up on the zero line now, with the PPO line starting to roll over, and that also comes on the heel of the divergent high there. So there's XLI. And again, I'll get to the daily charts if there's some time here left. XLP, consumer staples, mixed bag of technicals. You can probably see down below. I have the positive divergence, strong divergence recently at the low in December, and it's certainly played out for a rally, and it could play out for more. This is one of the bigger divergences I've seen. But we also had very big divergence heading into the highs here. So, again, a cross current of technicals. And I'll just say it this way, make it very clear. If this is, or if the stock market is going to new highs in 2018, well beyond, not just a marginal new high that reverses and then the big correction comes, but if we're going to go to new highs and chug along throughout 2019, if I said 2018, I meant 2019, then this sector looks good. It's a multi-year basing pattern here, and this could be a topping pattern, but you can see for the most part, staples stopped. They topped back in, well, there's the actual top, but they've been basing now for a couple of years, going nowhere. So that's it. You had that big divergent high. Now, this overrides what we've seen here, this divergent low recently, because we broke a major trend line. This is the bull market trend line off the 2009 lows, or again, I took some liberties on the lows, coming off that 2008 low. And that broke down, back tested, and so far, we really haven't gone much lower. We're moving sideways, and let's just keep it simple. we need to make a, have a definitive break above or below this recent trading range, and that will most likely tell us the next major trend. I'm talking the trend where you buy XLP, put it away in your 401k, set the proper stops in place, and let it ride. But as of now, it's been a chop fest. Certainly some swing trades in there to be made, and again, that's a very powerful divergent low right there. So that could be the catalyst to fuel us up and above that level. But if we're in a new bear market, though these are staples, they're defensive issue stocks, they tend to hold up better than growth stocks in a recession or a bear market. They will get dragged down. The baby gets thrown out with the bathwater in a bear market. Everything goes down. Utilities and REITs are also defensive issues, but they took it on the chin last quarter, and they also got clobbered back in the 2008 bear market. So don't be mistaken if you hear, oh, well, defensive stocks, utilities do great because they are, people don't stop paying their utility bill, their electric bill during a recession. Yeah, that's true. Their earnings are pretty consistent, but they get sold out, as everything does in a bear market, just due to mass distribution. So there's that, and XLE, energy sector. The energy sector topped back in 2014. That was the end of the bull market in the energy sector. It has been moving lower since. But bigger picture, if you really step back, a long period of time, you can see it's been just mostly moving in a giant sloppy sideways range. Now there's plenty of trades to be made in those ranges. You can see the uptrend lines, divergent high, and again, these are weekly charts, so these are not zeroing in on the entries and exits, but they're helping you identify when to go long and when to go short. And so what this chart shows you, let me add one more here. Let me grab another trend line tool. Darn it, here we go, down here. There it is. Okay, got it. There you go. So I see 1, 2, 3 divergent highs on the weekly time frame, and I see 1, 2, 3 very powerful, extremely profitable corrections to trade. This one, I believe, more to go. We'll see. And I see I had this one marked, a divergent low there. It was highlighted at the time on the site. There was also strong divergence right here. Doesn't look very big, but it was strong, sharp move up here. I'll go like this. You can see a little better. There's your divergent low. This is it, guys. I mean, this is not the holy grail to trading, but it's close enough. Just got to be patient. It's that whole steamroller analogy. You can sit back. It takes weeks or months for these long-term weekly charts to play out, for the technicals to play out, for divergences to manifest in the form of a correction, because you had divergence, guess what, at this point here, and you had it here, and you had it here, and you had it here, and it finally played out. Same thing here. So this trend line break in divergent high right here, we had a correction. We had an initial leg down. Corrections are very, very rarely one leg down. They are usually at least an ABC wave, and so far this is the first leg down, so this looks like a kickback rally. Trend indicator still clearly bearish, and that is also a pretty big sector of the S&P 500. Not as big as it used to be because of what's happened, and the S&P 500, they play games. I remember at one point, if I'm not mistaken, 10 years ago or so, this may have been the largest sector in the S&P 500. If not, I know it was up there, and now it ranks as it's only 5%, so it's actually one of the smallest at this point in time. Why? Well, S&P 500, I have no doubt they play games. They want they get royalties for all these companies that are indexing with the S&P 500, and so what they're going to do is strategically move sectors in and out. It's no coincidence that XLK is the largest weighting sector, because that's where the momentum and growth has been. And when this goes to collapse, I'm sure they'll rebalance and make it a smaller proportion, and probably throw in up utilities and REITs and all those other things that'll be doing better during the next bear market. Okay, guys, the video is running long enough. I'm not going to do the daily charts, but I will say, and I also did a coverage in both videos and static charts on XLU, the utility sector. Here's the weekly chart. I should update this. So you had a divergent high back here before the Q4 sell-off. There's what I was talking about. Actually, that was in early 2018, but there's the Q4 sell-off. Utilities dropped. But what happened? So we have the bigger picture on the weekly, and I don't even know if I covered this in today's video or not. I can't remember the early one. So we had a big old wedge here, it broke down, and we've been back testing. So that's the big picture. We popped a little bit above it, and that's concerning because that doesn't mesh well with what I would think would have happened. Now, we're not very far. We're only slightly above that level, and we'll have to see. Again, if we get a lot farther away, then this trend line will have certainly been recovered, meaning prices move back above it. But what happened since then is these divergences have only been extended right now. You can see the PPO is still making lower lows than it was back there at that high. So this is only a larger divergent high, which leads the way for a much larger correction, and in my opinion would be one down about that $42 level there if that whole bear market scenario is going to play out. XLREs, REITs, I told you that this one in the S&P 500, the spiders, is not been around very long. That's why I use IYR for long-term analysis. But again, I covered that in the video today extensively. And then finally, what I didn't cover was XLB, basic materials. And so here we're looking at, since the last bear market, there's that tried and true trend indicator down below saying be out, be out, be out, and be out of basic materials. And that PPO is starting to roll over. It hasn't yet turned down, but it's starting to roll over. And we're also at resistance here. So the basic materials, although they're not going to move the needle on the S&P 500, they're about what, 3% or so. It's the smallest weighted sector in there, but it is a sector at resistance right now. We had some divergence on the RSI at the lows, but again, those divergences have already played out for a rally. So this one has resistance to struggle with, as well as that trend indicator, which at this point in time is still bearish. So I'm going to end it here. There were a lot of levels I wanted to look at on the daily charts as well. If you remember, just drop me a line if you're interested or long or short any of these sectors, and then I can zero in on the daily charts or maybe even the 60-minute charts, give you some targets. Otherwise, any that stand out, like for example today with the utilities and REITs and tech, I will highlight those and consider adding those as trade ideas if and when the time is right. Right now, trade ideas are light because I'm not in a rush to add things in a sideways market. I see a lot of frustration in the trading room. We've had more stops hit than usual in the last couple months because of that, especially in the last few weeks. But I'm ready to pull the trigger quickly if this market starts to show its hand one way or another. All right, we're going to wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.